Despite reaching new all-time highs, the markets in the month of August have been mostly flat. What factors could keep new highs coming? Joining us now to discuss is Stephen Wieting, Global Chief Investment Strategist at Citi Private Bank. So, Stephen, we have been kind of saying the same thing every day at the closing bell. It's been this tight trading range, low volatility. What is driving the markets right now?
Well, think about this. Go up in capital structure, take less risk, and invest in credit. What would you have this year if you were a corporate bond investor? You'd have 8% returns. You'd have even more at the long end of the yield curve. You know, particularly in a period where we think that profit growth is about to be at least partially restored, it's not that much to ask, of equities to rally the same amount this year. And that's what we've seen in the United States and globally. This is about lowering return opportunities in other markets, yields falling.
And how big a part of that is the Fed right now?
Yeah, the Fed is creating a little bit of risk in that. If you take a look at where expectations are out through the end of next year, there is not a great huge hiking cycle priced in, nor should it probably be. But the Fed is pulling that forward somewhat. What happened at Jackson Hole created some uncertainty on interest rates near term and definitely brought up the probability, that the hawkish time is closer to now and the dovish time is out later.
And is that what we're seeing on a day like today? Utilities are down, we had financials up, the dollar's up.
Exactly.
That is all Fed-based?
Yes, since Jackson Hole, and again, what we're talking about on Friday. But what you saw today with financials moving up, with utilities moving down, with gold moving down, with the dollar moving up for the last couple of days. This is about that rotation and accepting that there's more near-term interest rate risk.
I want to bring up one of the charts that we have, the equities and debt correlations right now rising. So this chart shows the S&P 500 and the 10-year Treasury total return correlations. Those have increased substantially this year. How long do you think that will last, and is there any risk to it stopping?
Oh, certainly the more ideal situation is that you get higher real interest rates because of stronger underlying views about sustainable economic growth. And risk assets do well because of growth and not simply because of those lower, return opportunities and the idea that, we have a very, very short time to go in a bull market. So the ideal situation would be that breaks down. Unfortunately, what you've seen with credit rally, with equities rally, with treasury bonds rally, with emerging markets and commodities and equities all move together is that it becomes a bigger challenge. You're getting less value from diversifying a portfolio right now.
One of the things that surprised me in your note was talking about gold and actually moving into gold at this point right now. Looking really at the correlation there, not just with the S&P and gold prices, which have been negative this year, but just between what the Fed's doing and what impact that's going to have on gold. And because you think we're going into a hawkish situation, why gold right now?
Look, there's a downside scenario for gold. And again, it's the optimistic one for the much larger part of a portfolio that is filled for us with stocks and bonds.
So it's just a hedge?
Yes, entirely just a hedge. Saying what the exact right level for gold would be very difficult. I think gold hasn't fallen as much as oil has, for example, in inflation-adjusted terms. But it has maintained that negative correlation to risk assets while so many other correlations have picked up. And so its value in a portfolio of, providing something that will go up in price in 2 out of 3 scenarios. More central bank easing, or a very severe drop in risk assets, gold would outperform. And again, the downside scenario is the one that we would all ideally want, which is everyone to grow very well together.
Oil, because we talked a lot about the oil correlation earlier this year. And you talked about what's happening with oil now, which it's been falling. But is it important for a retail investor to watch what's happening in oil as we head into the end of the year?
It's extremely important. And I'd be careful that, we don't, for example, hold passive futures contract type, ETF investments that, really poorly track the oil price. But there are trillions of dollars of assets around the world, much larger than the petroleum market itself, that are closely correlated to movements in the petroleum price. If you think about the bull market of the last 7 years, only one significant industry has unwound all of that. It's the global petroleum industry. It's the only industry that really reflects significant recessionary conditions. It's beaten down. We've had capital investment fall 60% in the sector over 2 years. And that, from the supply side, out in the future, I think will rebalance and point to a higher oil price. So assets like whether it's Canadian equities or Brazilian shares, or importantly, emerging markets debt in Latin America, even for countries that have very, very small petroleum trade surpluses, they have powerful high correlation. And they were beaten down in the last few years. Since 2011, these are asset prices that have mostly fallen. We've been avoiding them for the last few years. This year, we started to come up, and we have small overweights now.
I know that the Fed plays into a lot of what you're thinking is driving the market. And I do want to bring up that today, Fed Vice Chair Stanley Fischer said that we are in a world where negative rates seem to work, which I think, some people thought negative rates were never going to see that, and if they even could work. Do you think negative rates are changing the investing equation at all?
Oh, absolutely. I mean, I think what is going on this year with credit, treasury bonds, equities all rallying is a reflection of what's going on abroad, where globally, just forget about negative yield sovereign bonds. They're out there. If you want to, pay, the Swiss government to borrow from you, you can. But investment-grade bonds of every maturity and every type of issuer, even risky corporates, are yielding under 2% globally. So again, this means a chase for yield. What I think it's done with the rise in asset values is made absolute returns looking out into the future lower. I don't think that they are horrifically bad. But now it's all about relative return. And the huge yield spreads that we see right now between different countries. Investment grade bonds can go from negative 60 basis points to 4.25% for hard currency debt. So these sorts of things, again, are very much driving markets right now. Now, when it comes to whether negative yields work or not, that really depends on exactly what you're talking about.
Right. We're still all trying to figure that one out.
Yes.
Thank you so much for coming in, Steve Wieting. Good to talk with you about where you think this market is going and what is behind it.
My pleasure.